Hi everyone, my name is Raphael, founder and CEO of Zendog Labs. Today I want to go through the how to value your startup framework or slides that I have here. It's really just one slide. I know how to talk about this because I'm a former investor, I'm a former startup founder, and I've been the VC in residence at an investor matchmaking platform called Fundant for the last 12 months almost. So I've seen a ton of deal volume, a ton of pitch decks, also just a ton of startup teams that have asked me questions about this, and so I put this into a video. All right, let's flip right through the options that you have here, and there are fundamentally 5 options that I see. If you have more options, let me know. I'm definitely curious to get your perspective on this too. So option number 1 is really valuing your business based on your funding ask. This kind of sounds intuitive, but especially in the earlier stages of startups like your pre-seed, seed, you don't have any fundamentals to point to or to use in order to make an assessment on what your valuation should be. So usually it's, a function of here is the capital that we need in order to achieve milestones that will be significant enough for us to get ready for your next funding round. And if we sell a reasonable stake in our business, let's say anywhere from 15 to 25% of the business, that's what our valuation turns out to be. I think it shouldn't certainly cross into the double-digit millions, but that equation should on average work out and look for a runway of maybe 18 to at most 24 months so that you have enough time to hit milestones, and that's the funding ask that you will come up with. It's really based on your internal assumptions about the capital that you need to make progress, and it's super easy to value your business and then say, hey, this is either too high or too low. How can we adjust this? Either by changing the stake in the business that we're proposing to sell or by adjusting our funding ask. Option number 2 is a really good one. On average, and I have a comment on this at the bottom too, but on average, you would value a more mature organization than a startup based on fundamentals that relate to cash flow and market pricing. Startups don't really have cash flow. Usually they are cash, they burn cash. And so an alternative to using a quantitative approach would be using revenue and taking multiples on this. And I would say in 2020, 2021, you had revenue multiples of 100, potentially even higher than that, which was pretty crazy. And now we have receded down to levels anywhere from 3 to 20. I would say it kind of tends to be between 5 and 10x your revenue. So let's say you are making 500K in annual revenue, then at a 10x value multiple, that would value your business at 5 million. And so that's where you also see how important it becomes to not be unrealistic about your funding ask and proposed valuation in the early rounds of your business. You need to grow into your valuation. And let's say you, quote unquote, only achieve 500K in annual revenue by the next time you need to raise. You need to make sure that your previous valuation was below 5 million. Otherwise, you have a flat or a down road, and that's going to feel terrible for you. So based on multiples is another one. And then the third one is based on the value of peers. You see this in the public market all the time, where you would define a set of comparable businesses and then say, hey, here is what their average valuation is. That's what our business should be, plus minus for XYZ reasons. The value of peers is you looking at comparable businesses that have raised in the past where you have publicly available data on what their valuation was, and then maybe adjust for your space and maybe your unique situation and the market conditions, and then that's what your value is. I would say I see that happening less than funding ask and revenue multiples. And it's probably also just a little bit limited, you're probably a little bit limited in your ability to apply this approach just because the publicly available information on average on startup rounds is going to be very limited. Maybe you have access to PitchBook, but honestly, even in PitchBooks, especially in Series C, sometimes Series A also, you don't have any information on this. Why? Because why would a startup publish it? Option number 4 is kind of an obvious one, but if you locked in a lead investor and there starts to be competition for the remainder of your round, you can leverage emotions and FOMO. If you have multiple funds or investors that are looking to invest in your business, you can potentially play them to some degree. You don't want to be exaggerating this. Ultimately, the capital is where the capital is, and you need it too. But if you're a hot business, that definitely plays to your advantage. If you wanted to increase the valuation of your business, and as you think about that, remember what I said earlier, you need to be able to grow into that valuation. And then option number 5 is on the cost to duplicate, especially when you talk to strategic investors. What they will think about is, hey, if I, what they usually think about is, I have a better team than the startup. If I used my team to rebuild what they've built, can I, how much will it cost me to do this? And many times that's going to be pretty low. You have personnel costs, and you have cost of time, and you have inputs, resources that need to be deployed into it. But it's probably not going to cost them 20, 30 million to generate an MVP and get to 50K in annual revenue. So if that's your valuation, don't do it. So these are 5 options I see for valuing startups. Again, if you know more, do let me know. I'll be happy to incorporate those. But I think these are the key ones. I've mentioned the comment on the bottom before too. If you are a more mature organization, what you will typically use is valuation approaches that consider cash flow and publicly available information. So a discounted cash flow analysis, also called a DCF, as well as comparables approach, where you would take your price to earnings ratio and compare it to what your peers have, would all certainly be relevant valuation methods. So the startup world is a little bit different, limited by how much cash your business has generated, how much information is available, and some of the differences in the mechanics of the deal making that are happening. All right, hope you found this useful. Questions, ideas, shoot them my way. My team and I at NoGlabs, we do focus on fundraising strategy and helping you build winning pitch decks. So if one of those 2 things seem relevant, then let us know. Bye-bye.